Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Cameron Dawson of NewEdge Wealth writing, the biggest question for 2026 is whether or not everything else can strike back and deliver the earnings growth that is necessary to unseat the narrow Mag 7 leadership next year. Cameron, I am so pleased to say, joins us now. Cameron, thank you so much for being with us and happy holidays. Great to see you. This broadening out trade and the real question behind it, when will we get the data and the information to understand whether it really is valid?
It really is a show me story in 2026 as to whether or not the equal weight S&P 500 can deliver on what are some pretty high expectations for earnings growth next year. If you look over the last 3 years, you've been in an environment where the largest parts of the market have driven the vast majority of the earnings growth, which is why you've had the vast majority of returns come from these Mag 7 names. But that's expected to narrow, not quite flip, but narrow in 2026. So you can see it in something like the equal weight S&P 500 having expectations for revenue growth to accelerate from 1.5% in 25 up to 5% in 2026. So a lot is riding on this idea of EPS delivering. And of course, that will be a show me story as we move through the year to see if there is upside to those numbers or if yet again we'll be in an environment where Mag 7 gets revised higher and equal weight gets revised lower.
So you add to this story something that happened last week. There actually was a big piece of news last week. NVIDIA had this agreement with Grok, which is a chip designer, some $20 billion valuation of this company, doubling it over the past couple of months, and raising questions about the dominance of NVIDIA, but also whether there is a shift in narrative around the AI story to one that is more efficient, more useful, and cheaper for some of the end users.
I think no better way encapsulates this idea of potentially a narrative shift is looking at some of the non-profitable AI-related names. They, of course, were leaders coming out of the April lows and saw an absolute frenzy as we moved into the fall with September and October rallies that were truly eye-watering. But what's been fascinating is that they have not participated in this latest move higher. If you look at something like the Goldman Sachs Non-Profitable Tech Index or look at something like ARC, those indices have not made new highs, which just suggests that maybe, just maybe, there's some rationality entering into this market, which we would welcome and see as a good thing, because that kind of rally in unsustainable, unprofitable names is not something that we would see as healthy for the market.
What do you expect from M&A in, not just the Mag 7, but in AI? I was pretty stunned after seeing that Grok deal when I looked on the FA function on the Bloomberg terminal to see free cash flow at NVIDIA is just gone parabolic, right? Last year it was 27 billion. This year it's 60 billion. Next year it's expected to be 95 billion. They are just raking in cash and are able to deploy 20, 30, 40 billion dollars without even thinking about it.
Yeah, I think it's a really good question, and it raises the question of where we sit in the semiconductor cycle, because we do know that at the end of the day, semiconductors are a cyclical business. And if you go back to prior cycles, you typically do see earnings grow by 100, 120% plus in up cycles. Then, of course, you do hit an inevitable down cycle. And we're now in an environment, if you look at the overall SOX index, that earnings are up about 150% off of the late 2022 lows, which just suggests that possibly we are closer to the end of this semi-cycle than we are to the beginning. But I think it's also very arguable that this semi-cycle will go further and last longer than prior ones, simply because of the secular tailwinds of something like AI. But it's important to remember that it's always this time is different with cyclical areas. If you remember last time, it was the Internet of Things and we were putting chips in everything, and that's why we weren't going to have semi-cycles anymore. I think the the real question will be is how much further can this go? And is that free cash flow that NVIDIA is generating today something that we can extrapolate into perpetuity? Possibly not.
Well, what happened, Cameron, to the terror of Liberation Day? I mean, the economic uncertainty that we were all wringing our hands about, right? These tariffs that admittedly have been muted a bit by the drop in the dollar, almost 10% year to date. Is any of that a concern next year, or have we realized that it's actually no big deal?
I think that if we were to see the tariffs as a concern, it's really captured in this conflicting kind of headline. We got a headline over the weekend saying that bankruptcies are at their highest levels since 2010. And then you pull up corporate profits in overall in the U.S., and they're at new highs. And so this suggests that tariffs are hitting things like smaller businesses harder. They're also hitting smaller consumers harder who have a higher propensity to spend of their overall incomes. So when you put that together, it really encapsulates this idea that tariffs exacerbate the K-shaped economy. They hurt lower income consumers. They hurt smaller businesses much more than they hurt larger businesses and higher income consumers.
I just wonder, Cameron, how long you can see this rally continue unless you get participation that does broaden out. This idea that you can see an economy that's growing at the fastest pace in 2 years on headline GDP. Yes, it's noisy, but a lot of it's data centers. It's not actually the mom and pop stores that are declaring bankruptcy.
The one thing that does give us a little bit of solace in thinking about this broadening out is contrasting where we are today in breadth measures versus where we were last year. Last year at this time, you only had about 20% of names trading above their 50-day moving average. It was an incredibly narrow market, which we thought made it more fragile. If you look today, that stat is at 64%. So it doesn't necessarily mean that we are immune to everything, but it is encouraging that we are seeing broader participation in the rally, that it's not resting on just a small handful of names. So using the banks as example, if the economy was really falling off a cliff, we don't think that we would be seeing bank earnings revised higher nearly as much as they are and banks hitting new all-time highs. Some of that rally might be a little bit extended, but I think it's important to note that there are still some signs that cyclicality is being well bid in the equity market, which just give us a little bit more comfort that things aren't as extended or maybe broadening out in a better way.
Stay with us. More Bloomberg surveillance coming up after this.
Debbie Cunningham of Federated Hermes writing, while the Trump administration attacks in the committee have intensified worry in the financial markets, we believe the Fed will prevail. This does seem to be the preeminent belief right now in markets. Debbie joins us now for more. Debbie, why do you think that the idea of Fed independence is kind of behind us and that people have sort of closed that story out in 2025 and look to a sort of more normal Fed in 2026?
Well, I think what we saw in 2025 was a surprise and then ultimately a divided Fed. We still don't know the full ending to the Lisa Cook story. We do know the ending to what the Supreme Court has thought about as Fed independence and a different type of body compared to some of the other ones. We saw President Trump go from, supporting Chair Powell to trying to fire Chair Powell to being told he can't fire Chair Powell to submitting to trying to find other replacements for him, interviewing replacement candidates for him for his expiration of his chair term in 2026. So I just feel like what we've seen so far has been a bit of a upheaval and turmoil within the Fed that now that the independence has been, solidified, I think that will not be the case going into 2026. However, what I do think will be the case is that we see less voting that is all in alignment. I think we will see more dissents. We've already started to see them in the last 3 meetings. And I think that will probably continue. And, what we've seen historically as hawks, centrists, and doves will become even a little bit more pronounced in their voting.
So do you think, Debbie, that people are overpricing the chance of rate cuts next year?
I think they are, at least from what the Fed is telling us with their, their dot plot, their series of economic projections. They are looking for one. Our official call right now, as we transport into 2026, is for two. One in the first half, one in the second half. But I think ultimately, although the pace of lowering rates has modified from where it was when we started 2025, the ultimate terminal rate, Lisa, seems to be the same. I mean, it's not going below 3%, and that's where I think the bond market is settling in. That's why you see, the 10-year rallying at various points. That's why you see a range trade that is really more indicative of actual technicals and market conditions, as we head into year-end, supply and demand, repo market, issues all seem to have more of a influence on rates on a day-to-day basis for this, last trading week of the year. But ultimately, when you look at the terminal rate for the Fed, over time, it's still at 3%. It's just 3% a year earlier.
I wonder how you view liquidity right now, given your position, and given that we're now have eclipsed $8 trillion in money markets. It seems like there's a lot of cash sloshing around the system. And we have pretty decent growth, right? Even though it's hard to look at these economic data points, 3.8% GDP, maybe only 2.6% inflation. What's your view on sort of the macro picture?
I think the macro picture at this point is that the worst is behind us. We really, when we went into 2025, were toying with the potential for some sort of a, substantial growth slowdown into a potential recession. That's behind us now, though, at this point. We think the worst quarter, obviously was the first quarter of 2025, and the consumer continues to be employed, so the consumer continues to spend, and the consumer is the one driving the economy in this recovery that we have been experiencing. So I think slow growth will be the case. I know not a lot of people like that from an equity market standpoint. It doesn't get the same, sort of splashy results that a faster growth economy does. But I believe that when you look at liquidity markets, when you look at broader term fixed income, slow growth is not a bad place to be, and we've seen that certainly in the gathering of assets in the liquidity market, as you said, recently passing the $8 trillion mark.
Stay with us. More Bloomberg surveillance coming up after this.
Veronica Clark of Citi writing, we continue to expect another slight increase in the unemployment rate to 4.7% in December. Veronica joins us now. Veronica, thank you so much for being here.
Thanks for having me.
Happy holidays. I'm just wondering from your perspective how much the data that we got earlier this month was actually valid and that people are discounting it too much.
Yeah, I think there's a lot of that going on. And if we saw the unemployment rate next Friday, the first week back to work, if we saw that at something like 4.7, I think people will believe it a lot more because, there's a lot of issues with the November, October data. We don't know how much the government shutdown affected the measurement of those months. But December should be relatively clean. And if it stays pretty high, I think that's a more concerning sign for people.
How come this labor market is weak? I don't get it because you've got incredible earnings growth, right? So corporate America is doing very well, and there are no new people coming into this country, right? There's no immigration. The demographics trend, like everyone's old. There are no young people. Like it should be companies are fighting for employees.
Yeah. I mean, there's been this issue of is it labor supply? Is it labor demand? We've been dealing with this for a couple years now. Back in 2024, when we saw the unemployment rate increase, the excuse was also it's more immigration. I don't think we can use immigration to explain the bad data, different sides of immigration to explain bad data. But I think what's happened is that labor demand has just weakened more than labor supply, and that's why you've seen the unemployment rate rising. It's this low hiring, still low firing dynamic, but I would be worried that low hiring can only last for so long before maybe you do see some layoffs.
So is that because technology and AI have made the few employees that companies hold on to more productive?
I'm a little hesitant to conclude that that's what's happening now. That might be part of the story, absolutely, and we could see larger productivity gains from AI longer run. But this really started a couple years ago. This really started maybe summer of 2023 when we saw this pullback in hiring. And I do worry that it started in more rate-sensitive sectors like manufacturing, small businesses. The pullback has really been there, and so it doesn't necessarily matter if equities are doing well and earnings are fine. Small businesses are going to be more rate-sensitive.
Aren't we bringing manufacturing back? I thought we were bringing manufacturing back, right?
We have been losing manufacturing jobs, I think, every month this year. But that predates this year also, and it is a rate-sensitive sector.
Well, this sort of speaks to the question of, is the Fed restrictive? And this is the big debate. Restrictive for who? Because on one hand, you do see companies filing for bankruptcy at the fastest clip going back to 2020. On the flip side, you see AI companies screaming ahead, Digital Bridge being purchased for $4 billion at a 15% premium. So can you square that?
Yeah, I mean, there's this bifurcation across all parts of the economy. I think there's a lot that has already been said about the K-shaped economy for consumers. Higher income consumers are spending, but we definitely see that in sectors also. And the smaller businesses who are more rate sensitive, I think rates are restrictive here.
So you expect a significant number of rate cuts. Let's just postulate that we do see an increase further in the unemployment rate to 4.7% as you expect. What does that mean for January 28th?
Yeah, I think they're going to be cutting.
Really?
Yeah, so we are penciling in another cut in January, another one in March. And it's just this kind of idea that you've clearly gotten more concerned on the labor market side of your mandate if the unemployment rate is something like 4.7 that we think we'll see in December. We will have hopefully more inflation data by March that we trust again, early 2026 data. If you're seeing inflation slowing and data that you believe again, and you're less concerned on the inflation side of the mandate, you're more concerned on employment, why wouldn't you be at the midpoint of neutral, which would be cuts in January and March to get you there?
The counter argument is if you get rate cuts, potentially 2 by the end of March, at the same time that you have the one big beautiful bill, the tax refunds, and potentially an additional $2,000 stimulus or whatever else might be coming down the pike, don't you risk reigniting inflation that never died?
Yeah, I'm not so concerned about that right now. The inflation driven by lower rates, more stimulative monetary policy, you would expect to see it first in a sector like housing, and you definitely don't see that yet. You don't see those signs yet. Home prices have been slowing. New rents have been slowing a lot. We already know that in the inflation data, there's this lag issue of shelter inflation. That's going to, I think, be slowing all of next year. All of the potential fiscal stimulus, maybe larger tax refunds, the business tax incentives that were part of the bill from the summer, those can help support growth. But I would worry that the main determinant of if people are spending or not is if they have a job and what their labor income is. And that we have seen slowing already. And you would think consumption would slow then too.
Stay with us. More Bloomberg surveillance coming up after this.
Stick with the consumer as focus shifts toward the new year. Data Telsey of a Telsey Advisory Group writing, heading into 2026, we expect events, higher tax refunds, and more accommodative interest rates to drive a continued recovery in discretionary spending, especially among younger consumers. Dana joins us now in person. Thank you so much for being here.
Thank you for having me.
It's wonderful to get your insights as we all look at our gifts from the holidays, decide which ones we need to return. What's your read on how well this season really did perform for retailers broadly across the sphere?
I think holiday season was solid. I think those increases, 3.9%, 4.2%, very much in line with expectations. These 10 days after Christmas are very important too, whether for returns, for gift card redemptions, all very important to see what it looks like. But the product newness drove demand, and with the K-shaped economy that we have, you're definitely seeing at the higher end and the lower end looking for value. And that's where you saw some of the traffic, whether it's the Walmarts, whether it's the TJXs. They were there. The last 10 days before Christmas, as always, is where you got the real bump up in terms of top line.
I'm fascinated by the bifurcation between Walmart and Target because I had seen them previously in kind of the same box, but Walmart has done so well this year and Target has disappointed. Why?
I think overall what you've seen from Walmart and Target store stands standards have fallen. You haven't seen the same innovation and product newness. You haven't seen the same forward momentum of movement, particularly with technology, where Walmart is anticipating what the customer needs. And they really have modernized their whole store format. The Walmart of today is not the Walmart of 5 or even 10 years ago.
If we see a K-shaped economy, do we get Dollar Tree, these Family Dollar kind of discount stores doing well? Because if I look at the stock performance, I don't see Dollar Tree taking off.
I think overall you will see those dollar stores perform. Keep in mind that in 2025, the focus on tariffs, who imports goods from China, was impactful certainly to the dollar stores, and now lapping tariffs should be a benefit to them over time. Who you saw as share gainers, it was all the off-pricers. I mean, whether it was Burlington, Ross Stores, or TJ Maxx, with the diversification of the assortment that they have, they captured customers.
What's fascinating to me is you're talking about how this was a solid holiday season, and yet we're talking about a bankruptcy potentially at the end of this month of one of the biggest retailers, of Saks Fifth Avenue, which faces more than $100 billion of a debt payment. A lot of people are wondering whether that will actually happen. Can you square this story? The idea that we're talking about robust sales, a steady consumer, albeit picky or choosy or whatever you want to say, at the same time that we could see a bankruptcy of one of the biggest retailers out there.
Well, when you think of who's gaining share from that, you look at the new brands that both Bloomingdale's and Nordstrom are putting on their shelves, stocking in their stores. They're gaining share. Just across the street on 59th Street, Bloomingdale's just opened a new extension to their 4th floor with newer brands, whether it's Victoria Beckham, whether it's Valentino, Totem. They have a whole new assortment of goods out there that, frankly, perhaps if not for this change, you would not see those brands in Bloomingdale's. And you're seeing it in Bloomingdale's and in Nordstrom.
How much is this a pattern that you expect to be repeated? That we're going to see wholesale bankruptcies of some retailers that are not keeping up with new product, while others, I'm thinking of Walmart or I'm thinking of Bloomingdale's, continue to gain share. It's sort of the big get bigger, can invest in technology, and you see wholesale bankruptcies on the other side.
Financial leverage is very important in order to keep the operations of a retailer running smoothly. You get into trouble with financial leverage, that's an issue. It always takes a lot to kill a retailer. They don't just die overnight. Take a look, for example, at Blockbuster from many years ago. And certainly we'll have to see what happens with that debt payment of Saks that's coming due very shortly. But certainly when one is weak, others can gain strength, and that's what you're seeing in Bloomingdale's and Nordstrom.
We talk about Bloomingdale's. Obviously, it's a great store. It's an iconic department store across the street here, but it's owned by Macy's, and that stock is down 30% this year. What's Macy's doing wrong that its Bloomingdale's is doing right?
I think overall, the Bold New Chapter strategy that the CEO of Macy's, Tony Spring, has put in place, they're making advancements, and you're seeing some change in Macy's also. You look this year at Macy's and what they've done, whether it's backstage with the off-price in their assortment, whether it's what they're doing with luxury, whether it's what they're doing with their own brands, and frankly, the store experience. The investments that they've made into the top 125, 150 stores is outperforming the core. And I think you're going to continue to see the assessment of the footprint of Macy's continue to be architected towards their best performing stores over time.
So you like Macy's? I mean, is this a buying opportunity then, this dip?
I think Macy's is an opportunity. I think when you think about next year and you frankly think about the enhancements that they've made to assortment, both in Macy's and Bloomingdale's, it's not expensive for where it is. And you look at the landscape of department stores that are public companies, it's Macy's, Kohl's, and Dillard's. Macy's has an opportunity on valuation to move higher.
Dana, do you think that early next year we're going to see pretty big price increases across the board for retail goods?
You're going to see more price increases coming, but keep in mind this innovation and newness that we have, you don't have a comparative. So we'll have to see what those prices look like. Consumers are cautious and discerning, but they'll buy what they don't have.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.